On the surface, the concept of dividend investing appears to be a simple one. Invest in firms that pay dividends, reinvest those dividends on a regular basis, and gradually build wealth over time. However, putting together an effective dividend income strategy for your portfolio is far from simple. Investors must understand which aspects to examine, which to avoid, and how to identify equities that appear to be performing well on the surface but might be in the process of collapsing. In today's video, we'll look at some of the most common misunderstandings regarding dividend investing and examine some of the myths. One of the first lessons most new investors learn is that dividend stocks are a good investment. Dividend stocks, which are generally believed to be a safer alternative than growth stocks or other stocks that don't pay a dividend, have a place in even the most newbie investors' portfolios. Dividend stocks, though, aren't always the sleepy, secure investments that we've been encouraged to assume they are. Dividend stocks, like all investments, come in a variety of forms and colors, and it's crucial not to paint them with a wide brush. Dividend investing can be a lucrative investment strategy for individuals, but there are a few things to consider before making a dividend stock investment. We'll look at the myths, mistakes, and facts of dividend investing in this video. First, let's take a look at some of the myths regarding dividend investing. Myth number 1. The only reliable dividend sources are utilities and telecoms. This misconception stems from the belief that only mature industries can pay consistent dividends. Utilities and telecommunications firms used to be among the most mature and steady dividend-paying companies. However, in the 21st century, established enterprises of all sizes in virtually every field are paying dividends. Myth number 2. A high yield is always a positive thing. The preceding assertion is absolutely untrue. Dividend yield is computed by multiplying the dividend per share by the share price. The higher the dividend yield, the lower the price per share. As a result, a high yield is sometimes the result of a quickly declining stock price. Before making any investment decision, investors should consider the underlying rationale for a stock's high yield. The last thing you want is to have your payout lowered when you least expect it. Myth number 3. MLPs are risky dividend sources because they are dependent on energy prices. Many investors have turned to master limited partnerships or MLPs in recent years as a source of high dividend payouts. However, many investors have been hesitant to use this asset class because they are concerned that the impact of rising energy prices may cause stock values to become extremely volatile. MLPs make money by delivering and storing energy commodities like petroleum and natural gas. They run the pipelines that transform fuel across North America. However, these businesses aren't as exposed to fluctuations in gas costs as many people believe. MLPs have access to relatively predictable incomes that do not fluctuate with spot pricing because they earn fee-based revenues. In essence, these businesses run the toll roads that charge tolls regardless of how much a car costs to pass through. Investors can use the Dividend.com stock screener to explore the universe of MLPs for shares that suit their requirements. Myth number 4. Investing in dividends is the same as investing in value stocks. This misperception stems from the fact that value investors seek out stocks that appear to be undervalued in terms of valuation, but dividend investors seek out firms that are undervalued in terms of dividends. These techniques are comparable, but they are not the same. The distinction is that one is focused on capital gains, while the other is primarily concerned with dividend income. Value investors are looking for equities that are trading at a lower price than the company's inherent value. Over time, this takes into consideration future cash flows, risks, growth, and other things. A low price-to-earnings ratio, price-to-growth, and price-to-book, among other ratios, are important to value investors. The idea is to use a margin of safety to compensate for any inaccuracies in these assumptions, and then profit from the capital gains. This is where the phrase "buy low, sell high" comes from. Many value investors will be drawn to businesses that have never paid a dividend and have little chance of doing so in the near future. Dividend investors, on the other hand, may take into account an entirely new set of considerations. While they are still attracted to equities that are undervalued in comparison to their inherent worth, there is a greater emphasis on picking businesses with long-term cash flows. Yields and payment ratios, as well as the likelihood of future dividend increases, are more of a worry. Myth number 5. Dividend-paying stocks are always safe. This isn't the case, and we've seen many instances of dividend-paying companies that have gone bankrupt in recent years. While many investors have profited from dividend-paying stocks, others have lost money by focusing solely on the dividend yield rather than the company's health. There have been numerous examples just in the last few years. Take, for example, General Motors, ticker GM, Bank of America, ticker BAC, Citigroup, ticker C, and Barnes & Noble, ticker BNS, all dividend-paying equities that have suffered collapses of one type or another in the last 10 to 15 years. The list goes on and on. Even though these companies paid consistent dividends at one point or another, they were not immune to industry and financial developments. Now, let's look at some of the common mistakes dividend investors make. Mistake number 1. They try to time the market. Trying to time the market is one of the most common mistakes dividend investors make. Even the professionals have no idea where the stock market's tops and bottoms are. The ideal strategy to invest for dividend income is to do it on a monthly basis with a predetermined amount of money. Using a company's dividend reinvestment plan, or DRIP, is one approach to do so. DRIPs are offered by most large firms, and the benefits include a low barrier to entry, typically less than $100 to begin, minor upfront fees occasionally, no recurring fees, and a low investor upkeep. Mistake number 2. Purchasing the stock in order to get the upcoming dividend or selling the stock too soon and forfeiting the dividend. Many investors make the mistake of focusing solely on a company's dividend record rate. For investors, the record date is meaningless. It is merely the day on which the company will review its records. The ex-dividend date, when the company's stock begins trading without the dividend, is the real crucial date for investors. The stock price has been modified downward to account for the future dividend payment. Almost always, the ex-date is the second business day before the record date. So, if you want to get the next dividend from a corporation, you must buy the stock 1 day before the ex-dividend date, 3 days before the record date. Mistake number 3. Not properly accounting for taxes. Another thing dividend income investors should be on the lookout for is a bigger tax bill than anticipated. If investors do not pay attention to the type of dividends they are receiving, this can easily happen. Qualified dividends are the majority of regular dividends received from the United States. Non-qualified dividends are taxed at the higher ordinary income tax rate, but qualified dividends are taxed at the lower capital gains rate of 15%. Dividends paid by a U.S. corporation or a foreign firm in a country with tax agreements with the United States are generally considered qualified. Although, throughout the 121-day period beginning 60 days before the ex-dividend date, investors must hold the shares for longer than 60 days. However, there are a few well-known assets that don't provide eligible dividends. Payments made by some types of ETFs, as well as payments made by foreign corporations from countries that do not have tax treaties with the United States, fall under this category. Now, let's look at some facts about dividend investing. Fact number 1. Dividends aren't just a perk or bonus. With all the chatter about finding the next Apple or finding the next 10-bagger, dividends can seem like an afterthought when it comes to investment returns. After all, what good is a 2% or 3% dividend return if your capital gains are 100%? Dividends, on the other hand, provide significant long-term value. Dividends have accounted for more than 40% of the S&P 500's average yearly return over the last 80 years, and that statistic does not include the compounding value of reinvested dividends. Consider this. Prior to the Great Depression, and even for a time afterward, dividends were the principal source of stock returns. Capital gains were only welcomed if they happened to come along. Fact number 2. Stock dividends aren't dividends. Some corporations used to issue stock dividends, which have been less prevalent in the previous 10 or 20 years. Companies would issue fractional shares of stock for every share owned, in addition to, or sometimes in exchange of, cash dividends. Although some investors may have been duped into believing this was a positive, what it really was were small-scale stock splits that added no significant value to stockholders. Fact number 3. Dividends and distributions are not the same thing. Not all dividend-paying equities pay dividends, just as not all stock payments are true dividends. Distributions are paid by partnerships, trusts, and real estate investment trusts or REITs. While distributions resemble dividends in many ways, investors see money appear in their accounts every month, quarter, or half year. They are not the same thing. To begin with, many of these businesses benefit from special tax treatment, virtually paying no income tax if they distribute a big portion of their profits. Furthermore, certain forms of partnerships might defer or expedite the realization of certain costs. This means that a distribution could include both cash earnings and what's known as a return of capital. These payments may be subject to a variety of tax classifications, and investors should be aware of the implications before buying big positions in such stocks. Fact number 4. DRIPs are simple and beneficial, but they aren't free. Dividend reinvestment is an excellent approach to grow your money over time. If an investor does not require the cash dividend a firm provides right away, the dividend can be reinvested in the stock, allowing the investor to purchase more shares with the money. While it's always been possible to reinvest dividends in equities, official dividend reinvestment plans or DRIPs make it even easier. DRIPs allow investors to avoid commissions, which can be a significant portion of the reinvestment amount in some situations, and occasionally even buy fractional shares of stock. Most brokers, as well as many individual corporations, offer dividend reinvestment schemes. DRIPs are a great way to grow stock positions quickly, but they aren't fully free. If the dividend is paid on a stock that is held in a taxable account, the payment is fully taxable just like any other dividend. Fact number 5. Despite the fact that many high-quality overseas companies pay dividends on their stock, international dividend investing comes with its own set of obstacles and twists. First, when those dividends are converted to dollars, currency fluctuations can have a major impact on their year-to-year worth. Furthermore, many overseas corporations withhold taxes on dividends, which may not be recoverable if the stock is stored in a tax-sheltered retirement plan. Last but not least, many overseas corporations have a different dividend philosophy. While many American corporations prefer to have a regular or rising dividend payment, many foreign companies prefer to pay a consistent percentage of earnings as dividends, which means that the actual dividend payment can vary greatly from quarter to quarter. For investors seeking consistent dividend income, this aspect alone makes some foreign equities undesirable. So there you have it, the facts, myths, and mistakes that frequently plague dividend investors. While dividend investing can be a terrific way to supplement your income, it's crucial to remember the lessons listed above. Investors should make sure their dividend investment approach does not expose them to more risk than they are comfortable with. Let us know what you think about the lessons we mentioned in the comment section below. If you enjoyed our content, don't forget to give us a like, and we'll see you again when we drop our next lesson.